Today we're talking about Applied Material here on Everything Money. We want to be your go-to source for looking at the financials of a stock prior to buying it. I know a lot of you out there, like myself, are just maybe buy some stocks, you watch the news and hope it goes up. The point is, let's take a look at the financials, separate the stock price from the company. They might not be in line. We will take a look right now with my dear friend. It's Paul. I literally almost forgot saying your name. It's Paul. And we will go over to Mo and see if people are trading AMAT in the Bidnast Nation. Paul, this company, I tricked Mo. This company is the world's largest. I told him it was the world's largest supplier of semiconductors. It's not. It's semiconducting manufacturing equipment. We get a lot of requests for this in our Discord community. This is Applied Materials. Paul, give it to me, baby cakes.
Guys, everybody follow us on Instagram. It helps us all feel warm and fuzzy. Mo and I hug each other every time we cross the new 1,000 mark.
Yes.
So this is a $123 billion company.
Jeez.
First thing to look at, 5-year PE. It's 34.8. We want less than 22.5. So that's an X. What this means is we want the current market cap divided by the average earnings of the last 5 years to be less than 22.5. So that's an X. Not a big deal. Doesn't mean it's too overpriced. We have to look at growth rates, etc. Look at this 5-year return on invested capital.
Pillar number 2.
18.5%. We want it bigger than 9%. It's over double. This means that they're very, very good at reinvesting the capital in the business through debt and equity into generating more profit. Yep. That's a very, very important thing, and something that you should look at when paying more for a company is if you believe that this return on invested capital is sustainable, you should be willing to pay a higher premium, which is why we look at this PE. By the way, side note, the 1-year PE is only 23. So there might have been a surge in profit last year, which we'll see. If the last year of PE is way lower than the 5-year, it means there's probably a surge. Dividend yield, 0.7%. Pretty lame.
Adorable.
822 million. So what we do is, remember guys, dividends aren't always safe. You have to compare the dividends being paid out to the free cash flow. So we look at the free cash flow. The last 5 years, it averaged $3.5 billion. So they can easily afford this dividend. And last year's free cash flow was $5 billion. So that's more consistent with this PE being lower. They had a big jump last year, probably because that whole chip shortage or something like that. Okay? So far we have one X and one check.
Pillar number 3 is revenue growth over the past 5 years, Paul.
All right, 13.87 to 21.6. But this is all over the place. Look at this thing. I mean, this is all over the place. I'm not a huge fan of that, but it is what it is. Want to figure out if this was because of an acquisition or because of the demand that was sitting there waiting, etc.
Pillar number 4 is profit growth, Paul.
3 billion versus 5.3. Now you see how that PE was very different, right? Because pretty much it was averaging 3 billion for the previous 4 years, and then last year they did 5.3, which will really drive down the PE.
Shares outstanding. This is literally how many shares exist in the world, and hopefully they're buying them back so that our shares are worth more, Paul.
1.07 billion versus 908, about a 10% reduction. Again, guys, this is making the pie smaller, which means that every share you own, if they keep buying back shares, you're going to get a bigger piece of the revenue profit. Now, the software you see before you, in front of you, this was created because our users actually requested it.
Yes.
We created the software. What we're doing here is we're trying to provide this knowledge. The software includes the mobile app, 8 pillars, 30 years of financial data, stock analyzer tool, exclusive daily content for only people in the app, access to all of us. Most importantly though, a Discord community. Over 6,200 people have access to Discord community. You can go talk to them about every type of investment you want, including crypto, because there are crypto fans in our community. All of this for 87 cents a day. Folks, if you are serious about your financial future, this is 87 cents a day, less than a cup of coffee. I guarantee if you follow our steps, you will make a lot more money in life versus $199 a month, $199 a month, and $35 a month. No brainer. Click the link below on Patreon or go to everythingmoney.com and save the sales tax. This is a no-brainer. Back to the 8 pillars.
Paul, just running the retirement calculator on your phone one time will drastically open your eyes about how much money you need to save or how much you might not need to save if you're doing well out there. So pillar number 6 for Applied Material is the total long-term liabilities divided by free cash flow. And we want this number under 5, everybody.
Easy calculation. We go to the 5-year average free cash flow from the main page. 3.5 billion multiplied by 5, we have $17.5 billion. So what this means is I want to make sure that the total long-term liabilities in the company is less than 17.5 billion. Why? Guys, it's just very straightforward. The less debt you have, the less debt you have, the more likely you are to succeed because you don't have crippling debt. Not many people go bankrupt with no debt. Just like companies, the less debt they have, the less likely they are to go under. So we go to the balance sheet, we scroll up, we go to the balance sheet, scroll all the way to the bottom, $7.3 billion. This is $10 billion less than our number. This is great. I love it. I'm not saying that number is always great, but if it's high, doesn't mean it's bad. If it's low, doesn't mean it's good. It's just, but you see it's about that 2.4 times, et cetera. That's pretty awesome. So now, guys, the big mamma jamma, cash flow.
Free cash flow growth, yeah.
We want to see free cash flow growth. So we go to the cash flow statement. Free cash flow is cash from operations less your capital expenditures. You'd use this to buy back shares, pay dividends, pay down debt, and make acquisitions. 3.67 to 4.99 check mark with the average, like we said before, 3.5. So our last pillar, we take this average over the last 5 years and we determine a value by multiplying it by 20. Does 20 mean it's the exact number? No. Your multiple of free cash flow is going to go up and down based on growth rates. Okay? But right here, we're at $75 billion.
Uh-oh.
Yes, correct. What was the market cap?
$123 billion.
So that's an X. So according to this metric, it's expensive. And if you go to our 8 pillars tab, it'll even show you that this company has all checks except for the valuation parts, the PE and the free cash flow. So right now I just think to myself, okay, it's just an expensive company. I like everything else potentially. I like Applied Materials. I like the company essentially potentially, but it's expensive. So when Mo does his charts, I'm going to use a stock analyzer tool, which is included in our software that will allow you to enter your assumptions to see how much you should pay for the company. Because remember, every investment is the present value of all future cash flows. This is going to tell you that number.
Mo, were people trading this in the Bid and Ask Nation?
So it's not a stock that I see that flies across the Discord all the time, but this is the previous high up here, and you can see that it's tested it several times. Now, the issue I have looking at a long-term perspective on this and the long-term stochastic is, Seth, you can see it doesn't really spend a lot of time up here in this overbought area above 80%. It often plays below that area, and it has these big spikes, but it declines.
Is this a year? What's going on? This is a crazy chart.
This is dating back to dating back to March of 2020. So it's 7-8 months, but you can see how insane it is.
Just sits there.
It just consolidates in an area, and it really doesn't get in this overbought area. I have not seen something like this in a very long time. I'm perplexed, but that just tells me don't trade that thing from a long-term perspective. Let's go over here and look from a daily perspective. This one is a lot better. You can find these little channels of having a really nice increase in stock price. This is a very, very good looking swing trading chart. You get very good consistent volume. You have pretty nice channels that you can go and trade through. Right now you're just hovering right at 3 major moving averages. So if you can pop above that, we know how far this is away from the highs. So there's a lot of room to play in that area. Get over these moving averages, let this thing turn up, and this is actually probably a very good swing trading stock. Going long term on this, not so much. Day trading, probably not.
If trading speaks to you, you can join our community. One of our 6,200 members will be winning a Tesla come Thanksgiving, and we're giving away a second Tesla. And so one of you is going to win it. And if you're interested, click below. Paul, show me the stock analyzer tool. You
all right,
sly
so
fox,
the biggest thing is to assume revenue growth. Now, the revenue growth last year, it shows you the 1, 5, and 10-year annualized numbers. Last year, it was just a fluke. 5 and 10 years, it got faster. I'm being more conservative because I just don't believe that as companies get bigger, they can really grow sustainably for a long time at higher growth rates. But maybe it can because, guys, technology is becoming more and more powerful, and they need to make more and more powerful machines in order to make these more and more powerful chips. So maybe it happens. Share buybacks, I did my assumptions here. Profit margin, free cash flow margin, PE assumption, free cash flow assumption, and then my returns. Very simple. I hit the analyze button.
The price is $135.
All right, so according to this, only if your high assumptions are correct, you're probably going to make about 10% return here. But if you want to make a value investing type return of 12%, you got to wait for it to drop about 40%. Seems like a lot. Guys, you'd be surprised how many companies drop 40% at any given time. To me, this is a company I want on my radar, and I'm going to keep it on my radar until the price falls. I think this is a great opportunity. Now, if you believe my assumptions are low, even on the high side, this might be a buy for you right now.
Oh, Paul, a year ago, the stock was $56.
Oh, wow, really? Wow, that's impressive.
So it does happen. It's just had a huge run up.
Yeah, and just like a huge run up, it's actually easier to fall than it is to run up. So just keep that in mind when you do these things.
That's our take on Applied Materials. Watch a bunch of our videos. We're giving away a Tesla. Join the community. We love you. And join our live streams every morning with Mo at 9 a.m. And we go live to everyone in the world Tuesdays at 2 p.m. Eastern. So if you have questions, bring them, baby. We love you. Thanks for watching. And click the next video and see if you love it. Fondle that thumbs up. You know I love when you tickle it.
And
See you
follow us
guys.
on Instagram.
Oh, yeah, on Instagram. Love you guys.